Hi, this is Scott Cooper from Andreessen Horowitz, and I'm here with Preeti Casaretti and Jamie McGurk from our corporate development teams. And we want to talk today a little bit about SaaS valuation. So I'm going to kind of start it off. For me, if you watch any of these, news programs, in the morning on all of our favorite cable news channels, it's pretty easy to hear the constant refrain, which is, "Holy cow! These SaaS companies are overvalued. What is going on here? Are we back in 99, 2000, just like we were, kind of 14 years ago?" And I think, what people need to understand is, a framework for how to even evaluate if that's actually a true statement. So, that's what I'm hoping we can cover today. And I thought we'd maybe kick it off with Jamie, give us kind of, a perspective on, what do you think is going on? So what is kind of causing all this bubble talk? And what do people need to understand to actually figure out, look, is it in fact the case that we're in the bubble, or is this all just normal behavior?
So I think there's two things that people look at and point to the bubble, and one is revenue multiples that a lot of these SaaS companies are trading at, and I think it's both current and future expected losses, so lack of profits of a lot of the current public SaaS companies. That people look at those two things and they say, "Holy cow! Workday is trading at 1.20 plus times revenue and expected losses for years to come," and they say this has to be a bubble. And I think those are the two metrics that people tend to focus on that leads them to conclude that it's we're in a bubble.
Yeah, I think that's right. So we've kind of trained the world to say the way you evaluate companies is you look at the income statement, right? And you say, okay, how much revenue does this thing generate, and how much earnings per share does it generate? And if those are good, then we all clap and applaud and go buy the stock. And if they're not, we all run for the hills. So what's the problem then? And maybe Preeti, you can kick us off here. So why is that wrong? So what's the problem with actually just looking at revenue and EPS for these SaaS companies?
Yeah. Well, for SaaS, it's a little bit different, right? From perpetual models. In SaaS, you're getting the revenue from the customer over an extended period of time. And so whereas perpetual models, you can look at the income statement because you get the revenue for the license in the period that they pay for it, and then you get maintenance fees over time. So you're covering your costs and right away from the perpetual license. But in a SaaS, you get it over time, and so that profitability doesn't happen until a certain period in the customer's lifetime. But once they become profitable, you have this huge existing base of customers that are paying you recurring revenue over time, and your margins are actually higher than a perpetual model.
Yeah. So maybe we should unpack it a little bit because for everybody. So maybe just a simple example, the way I think about it, right? So if you're Oracle, right, in a traditional model, I go sell you a license for $10 million. I get that $10 million from you. And then in the quarter in which I sold you that business, I got $10 million that flows right through to my income statement, right? So all is good. And I can pay my sales guy. I can pay all my other folks. And so I think, unless you guys disagree, that for a company like that, the income statement is actually pretty good. That's a pretty relevant indication of what's happening in the business, right?
It is, and importantly, the cost to acquire that company was incurred in that period before or during and as they paid for it. So that cost is realized upfront.
That's right. So we can actually see the profitability of that customer right away, right? We know that customer paid us $10 million. We know we paid a sales guy a commission. We paid some engineering guys to develop the software. And so we know in that quarter, whether that was a good purchase or not, for us as a company. And so I think, and then, if we kind of just use that same example on the SaaS side, right, if, you're Workday, for example, right, and you sell a $10 million deal to a customer, that deal could be over 12 months, 24 months, 36 months, depending upon kind of, what the contracts are. And so, Preeti, to your point, you've got this weird imbalance, which is, I've signed a contract that says I'm getting $10 million for the customer. There's no way that customer is actually paying me $10 million today. They're going to pay me, month by month as they use the service. And so I've got this weird thing, which is I've got to go still pay the sales guy. I got to pay all the engineers. I got to pay all the support folks immediately for that thing. But that $10 million now is not coming in one quarter. It's coming in either 4 quarters, 8 quarters, 12 quarters, right, depending upon how it works. So is that the right way to frame it? Is that kind of the fundamental kind of thing that you think is missing when people look at simple revenue and EPS?
Yes, exactly. And that's why we tend to look at billings as well, which is the kind of contracted revenue that you have coming in from customers, and that really is like a leading indicator of revenue growth. And that's why you see a lot of investors focusing on billings more so than revenue itself. Because if Workday, for example, signs a 3-year contract with the customer and they have that unearned revenue on the balance sheet, you know that that revenue is going to be coming in over the next 3 years. So there's predictability in the cash flow, there's visibility into the future. And so what's different about SaaS is that a lot of financial analysts like it because you can really predict the cash flows over time. Whereas in a perpetual license, like you said, it's really every quarter or every year you have to go out and acquire new customers. With SaaS, you have an existing customer base, and so you know that you're going to get revenue from that.
Yeah,
already.
let's come back to that one. I want to actually pick up on the billings comment you made because, my like spidey senses start going off every time we say, hey, forget about metrics that are actually in the financial statements. Let's go make up some new metrics to actually measure the business. And, again, for those of us who are old enough to remember 99, 2000, we used to talk about things like eyeballs and stuff like that. And, you couldn't find those things anywhere on the financial statements. And so, I think people always get nervous, right? And this may be some of the skittishness you have in the market where people say, once you have to actually invent metrics, to explain why a business is valued a certain way, that's scary. So maybe you can just, to unpack billings, right? And maybe Jamie, you can kind of, jump in here, give people a sense of what that means and also like how they actually see that in the financial statements as opposed to the three of us just saying, hey, just trust us. Like, the billings are actually really big.
Sure. I think a great example of that is Castlight's recent IPO where, if you look at what the revenue was, on the income statement on a trailing basis or even on a forward projected basis, it was fairly modest and certainly didn't justify the valuation that Castlight achieved post IPO. What investors were really looking at was the billings, and I think that all comes down to predictability. With a big billings backlog, that helps investors predict what next year's revenue is going to be, and even the following year's revenue is going to be. So, if you think of billings as a backlog of future revenue, that really gives comfort that the growth rate is there and that they will achieve those revenue milestones.
Right. And I know it's not always the case, but oftentimes you can get a good proxy for billings by looking at the balance sheet, right? So you can look at things like deferred revenue and, there's all kinds of course, funky accounting rules why sometimes some of it may be in there and some of it maybe not. But my understanding at least is, when the Wall Street analysts look at these things, they're looking at kind of changes in deferred revenue kind of quarter over quarter as kind of a proxy for this concept of billings. Is that pretty right?
Yeah, exactly. Deferred revenue is a liability that's on your balance sheet, and it definitely usually represents like new billings that you acquired in a quarter that you haven't serviced, or renewal billings that you're getting from existing customers that you haven't serviced yet. And so any change in that will kind of indicate whether your billings are growing or shrinking, and that's a really good leading indicator into like revenue growth.
Right. Well, that's good to know. So, right, when we're talking about billings, we're not literally inventing kind of new financial voodoo metrics. We're actually talking about things that people can look to the GAAP financial statements and get, a good sense of how they are. I want to come back to something Preeti said earlier either, which is this whole concept of acquiring a customer with the idea that that customer is profitable, but potentially over a longer period of time than we're used to thinking about, right? So again, if we kind of go back to maybe the simple example we started with, that Oracle customer, that customer is going to give us a bunch of license revenue up front, so they're immediately profitable, which is a great and wonderful thing. And then they'll typically pay us a maintenance, an annual maintenance contract, right? Maybe 15 or 20% of the software license revenue. And that's all good. And that's actually quite profitable revenue. But, Preeti, you kind of mentioned, which is I think people don't quite, have a firm grasp on, is in a SaaS company, what we're doing is we're saying, hey, we're going to spend a bunch of money up front to acquire this customer. On our income statement, it's going to look bad, right? So it's going to look like we're crazy and we're burning cash in the parking lot, right? Because of that. But the whole theory is that customer probably is going to be with us for a long time. They're going to be sticky. We may be able to sell more stuff to that customer over time. So maybe just, give a perspective on what is it about SaaS? Why should people believe that SaaS customer is going to stick around for 3, 5, 10 years any more so than, that Oracle perpetual license customer? And how does that kind of, play into how people think about long-term profitability?
Yeah, sure. Well, in SaaS businesses, it's two different sales, right? First, you're acquiring the customer, and then you're retaining the customer. And so we look at a lot of metrics around that, around churn and so forth, which give us that conviction that a customer is going to stay with you a long time. And so if your churn is low, then you know that you're going to keep that customer for, let's say, 3 years or so. You have an idea of how much that customer is going to provide value for you over their lifetime. And so if you can sort of compare that to how much it costs you to acquire them and see whether you're becoming profitable on a company, that's a good indicator of whether you can you can sort of like sustain and continue to spend money to acquire customers. And what happens is that the more you sort of spend money to acquire customers in the beginning, the more negative you go in cash flow. And a lot of investors have trouble sort of understanding this. For example, a company will spend a ton of money and acquire customers, and they're just starting to reach profitability. But when they actually accelerate that growth, they'll go into an even deeper negative cash flow. And then when they come back up to reach profitability, they'll start growing faster. And that's that balance that a lot of investors and sort of board partners don't understand. And right when you're about to press the accelerator, a lot of people will tell you to stop, no, slow down growth. But that's in fact not the case for SaaS. In SaaS, it's more of a sort of a land grab kind of market where you have to acquire a lot of customers early on and become the market leader. And then that's what investors are paying up for. And so that idea of negative cash flow in the beginning versus a perpetual license where your cash flows are generally pretty not as negative is something that investors struggle with.
Yeah, that's definitely an interesting point, and I do want to come back to that one. But Jamie, let's kind of dig a little bit deeper on this concept of customer acquisition cost, and then Preeti mentioned, I think, kind of lifetime value, right? And so you just maybe help people understand how to think of those because, again, the way I think without people kind of understanding the details, there's always this fear that, hey, we're spending a bunch of money to acquire this customer. We have no idea if that's actually a good thing or not, right? So how do, kind of investors should think about kind of, how much money should I be willing to pay for a customer relative to like how much value I think I can get out of that customer over a period of time?
Sure. So in previous the previous perpetual license model, you go out and you acquire a customer, and you can base that against what that sale was worth at one time. So that's fairly straightforward. Over in a SaaS model, as Preeti mentioned, it's the customer lifetime is uncertain. So it's hopefully in perpetuity as well, but you really don't know. So you have to if the stickiness of your customer is really dictated by in part by the product, really, because you have constant updates. If you're a Salesforce customer, if you're a any SaaS model customer, you're constantly getting updates to the product, even on a daily, weekly, monthly basis. Versus you have a product that you buy and you buy maintenance for a 3-year period. You're making another purchase decision at the end of that 3-year period. So you almost have to spend to reacquire that customer if you're the company selling them the product. Versus in a SaaS model, the purchase decision is made one time upfront, and of course the relationship with that customer dictates how long they stay on board. But you have the opportunity to keep that customer and make them sticky. Yeah. So I think those are the two things that you kind of have to balance.
I think that's interesting. To me, I think there's a very good argument for why a SaaS customer is a lot more sticky, and I think a lot of it has to do with that. I think the other thing is, and we see this a lot in companies, which is as purchasing decisions have moved away from kind of the CIO as the central, kind of purchasing control of all these things, and now you've got department level purchases, and you see a bunch of SaaS companies, Marketo would be a great example, right, of a company that's, selling to the marketing department, right, whereas kind of in the old world, you had to always sell to the CIO. And so to me, part of the stickiness argument, I think, in favor of SaaS is you've got decentralized budgets now, right? So you don't have a single throat to choke anymore in the company. You actually get to go sell to the marketing department, which I think as a vendor is actually a good thing. And then at the same time, because SaaS is so easy to use in many cases, and user interface is a really big component of this stuff, there are probably many more users in each department of these SaaS products than we actually ever had before. So again, if you go back to old ERP products, right, there were probably 5 to 10 to 20 power users in these organizations who ever touched these things and knew about them. Now you go to salesforce.com, right, literally every inside salesperson, every customer account person has a license for this stuff. And so I think, to me, those are arguments why this kind of software is even more sticky than traditional software, because it's just kind of permeated the enterprise in a different way than traditional products. You guys think that's true or no?
I do think it's true, and I think there's one other component too, which is there's a lot more cross-functional collaboration. So marketing to engineering, or marketing to the direct sales, or to the to the corporate office. I think a lot of that collaboration has allowed these systems to proliferate. So as they kind of use the same systems, they're on communicating across the same systems. That has we've seen a lot of these systems proliferate throughout an organization that way as well.
Great. So I want to come back to a point, Pretty, you made earlier, and I would kind of call it the growth hurts problem, which is these SaaS businesses are weird in the sense that the more customers I acquire and the faster I try to acquire them, you have this, major kind of negative cash flow problem. You almost exacerbate your financial statements and make them look worse, even though you're actually trying to do a good thing, which we think is grow the business faster. So, in the end, does that all work out? And is that a rational strategy for these companies to do? Or, are we better off just saying, hey, look, cut the losses, don't grow so fast. Let's just kind of harvest what we have and kind of be happy with the business?
Yeah, sure. To sort of answer that question, I want to use NetSuite as an example. So if you look back to 2010 to 2012, they spent a lot more on S&M and they went into negative cash flow territory, but that helped them accelerate revenue growth. And although their bottom line was looked bad, their top line looked great, and that's good. But then how do you know over time that it's going to look better, right? And what you gain conviction from that because by looking at by understanding the fact that an existing customer costs a lot less to service and keep than a new customer. So there's stats out there that show that an existing customer costs 1/3 the cost of the cost to acquire a new customer. And so as you're if you look at the sort of breakdown of your revenue, as the portion that's recurring versus the portion that's new increases, so that means the more renewal revenue you have, the higher the margins are on that renewal revenue because you're not spending as much money on the renewal customers. And so your profit margins grow up over time. But it's hard to tell that in the early years of a SaaS company. All these SaaS companies are 6 to 7 years in their lifetime, and this is going to happen 10, 15 years down the road, and it's going to take a while. They have to kind of establish that big customer base and that large recurring customer base before you can really say they have really strong margins. But based on what they've sort of been tracking and their margin improvement over time so far, I think we can say that they're on the right track.
Right. So we've seen, at least in the public companies that have been around for a little while, we've actually seen, demonstrable improvements in their margins over time, right? Yeah. We're not yet to nirvana in the sense of, they're not, throwing off, 30, 40%, operating margins yet, probably for most of these companies. But it sounds like at least there's enough traction to show that, hey, versus, a couple of years ago, now that that growth is paying off in many respects in terms of margin improvement. Is that fair?
Yeah, exactly. And SaaS businesses generally have higher gross margins as well, so it gives you more room to kind of pump money into sales and marketing and R&D and so forth to continue that product development that you need to do to have a sticky customer base.
Yeah. So, Jamie, maybe you can comment on this. I think the other thing that maybe gets lost a little bit here, and it's a little bit nuanced in the technology, is what other economies of scale are there for SaaS companies over time? So we've talked a lot, right? And Preeti just brought this up, which is this concept of sales and marketing scale, right? Which is, hey, it costs a lot of money to buy this guy up front, but the costs of servicing that customer over time are low. The other one that I think people don't pay as much attention to is on the R&D side, right? So this concept of, you hear people talk about this concept of multi-tenancy, and at least my personal view is that also means to me that over time at scale, you ought to actually have much more, research and development kind of leverage in these companies than you do in a traditional perpetual license company. So, I don't know if you agree with that or not, but maybe just, give some perspectives on, what that might look like and what that means.
Sure. And I think it's particularly evident in models that involve hosting and storage and networking. So the multi-tenancy that you point to is often used. That's a term that's used when talking about cloud type deployments. And so if there's a shared infrastructure or a built infrastructure that you can amortize over a larger number of customers, they're in essence sharing that cost.
Right.
So you get a lot of leverage to the extent that you are fully utilizing that infrastructure and spreading it over a number of customers, a number of deployments, and therefore a larger revenue base. You do get a similar type of leverage that.
Right.
That
so you've almost got, again, it's we've talked about kind of timing issues in SaaS companies, right? Which is timing of revenue and timing expense. This is almost a second timing problem, which is in order for me to go sell to my first customer, I've got to go buy some storage equipment. I got to go buy some network equipment. I got to build this software. That's a big fixed cost that I have to undertake. And, my hope, of course, is that as I build more and more customers, that cost that gets to the marginal cost that gets assigned to each customer ought to be better and better, right? But again, you've got this, funny timing issue, which is to go get those customers, I have to actually incur this first big fixed cost. And so again, kind of when I look at my income statement, I've got small revenue, big expenses, but I have to kind of wait over time to see how that works. Is that kind of the way to think about it?
Yeah, that's right. It's not completely. You don't incur the entire cost up front and then amortize it over time. It's but it's also not modular. So you're not adding a fixed number or a fixed amount of incremental cost per customer.
Right.
So of course your infrastructure can scale over time as you grow the business. But to your point, you will have to start with a fixed amount of infrastructure, and to the extent that your growth can support that, it doesn't grow linearly. It's you're getting some leverage.
Right. So certainly at a minimum, from a cash perspective, right, I'm going to have to go be out of cash on this stuff. You're right. The accounting laws may help me amortize and depreciate that expense over a period of time. I think the other part about this too, which goes back to the core of multi-tenancy, and a lot of us here came from the enterprise software world. When you had enterprise software, you were always maintaining multiple versions of the software all the time, right? So you had customers who were on version, 1.x. You guys probably saw, Microsoft just deprecated, what was it, XP or something the other day, and there was this whole outcry. It turns out that every ATM in the world, right, is being run on XP, and so now we've got to go figure out if our money will actually come out the next time we go to the ATM. But, my point is that in an enterprise software world, you always are maintaining different versions, and you've always got customers on different versions. And that has a real cost that I think, people who haven't been in the business don't appreciate, because now I've got, engineering teams dedicated to it. My support teams have to be kind of bifurcated. The beauty, I think, at least of multi-tenancy and SaaS generally, which I think also goes to our broader point about why these companies ought to be more profitable over time, is every customer, or at least in most cases, most customers are running the same version of the software, right? And so I've got all kinds of economies of scale of my R&D organization not having to worry about that version that I released 10 years ago and what legacy customers I have. And so, again, Preeti, I know we're not quite, yet, to maturity for most of these companies, but is it logical to think that R&D expense, again, as a percentage of revenue over time, for these companies ought to be lower than they are in traditional companies, and therefore, again, another reason why we think profitability is better for SaaS companies?
Typically, yes, because you're not maintaining multiple versions for multiple customers. As you said, you have just one customer with SaaS, and that's the beauty of SaaS, really.
Yeah, it's interesting. The other thing, I was going to take us to a completely different industry, but I think has a lot of analogies to SaaS, which is, the cable industry, the telephone industry. So what's interesting to me is none of this stuff is actually that new, this concept that we're talking about here, right? So if you think about, a company like Comcast, right, or you think about AT&T, they've got this same problem, which is, it costs a lot of money to acquire customers, right? It's one reason why the marketing budgets, right, for these companies are so big. But the reason they're willing to do that and spend hundreds of millions of dollars on marketing is because once they get you as a customer, the likelihood of you staying is pretty good. And then now they've got this, again, same thing like SaaS, right? It's a subscription business, right? So every month they're charging your credit card for a certain amount of money. And then, I think it also explains why, every time, you threaten to kind of, switch from AT&T to Verizon, they're very happy to accommodate things and try and kind of, keep you as a customer. And so, I don't know, Jamie, if you look at it, maybe there's other analogies in the market, but, what is it that's giving people so much, kind of angst about SaaS when, in reality, subscription businesses have been around for a long time, and there's really nothing new here. Is there something else you think that's, making this harder for people to understand, or is it just that because everyone's been trained on the perpetual license model, that this is just kind of a natural thing that people have to go through, which is a switch in their mindset from perpetual license to recurring revenue businesses?
I truly believe that it's more of a switch in the mindset, because fundamentally, the difference between whether it's an Oracle or kind of one of the older perpetual license model, fundamentally they're delivering the same end result to a customer. They're just doing it in a different way. So I think I do believe it's more of an understanding, not just how the business model is shifted, but how the impact on the financial statements has shifted, and how the profitability of a new SaaS company or a relatively young SaaS company is going to look different than the profitability of that Oracle, SAP, Microsoft, et cetera. So, of course, those are in different stages of their life cycle, but at the same time, they're fundamentally realizing revenue and costs in a different timing period. So I think it's a retraining. It's not a total brand new thing. It's just a new way of looking at a similar type of product.
Right. Okay, so if we're just to net it out, maybe I think where we kind of came out is we've got this fundamental problem, which is everyone loves to look at the income statement, right? And that's, we've trained the whole world to say, look at revenues, look at EPS, and then let's figure out, what revenue multiple, what PE multiple to be put on these businesses, and that's how we ultimately value them. And it sounds like, at least based on what we've talked about, you've got a fundamental challenge with that model versus the SaaS model, which is you've got all these timing problems that revenue doesn't all come in up front like it did in perpetual license. Most of the expenses do. You've also got this other concept of, I've got to incur lots of costs to incur a lifetime value that we think is going to be very net positive. Certainly, we'll kind of see over time. And so, it really is, I think, a function of helping people understand, what are the proxies they can look for in the near term, right? So Preeti, you mentioned it kind of, what is the customer acquisition cost relative to our projected lifetime value? And these are all things that actually we can estimate based upon the financial statement. So we have to kind of, help people look towards those types of proxies as opposed to kind of, going back to the traditional valuation, parameter we've talked about. Well, thanks. I appreciate the time. And I was joined here with Preeti Kassereddy and with Jamie McGurk from the team, and we're signing off.